Hello, financial enthusiasts! Welcome back to Stock Market Catalyst, where we reveal the secrets to financial success in building a solid foundation for a brighter future. Day trading involves buying and selling financial instruments such as stocks, currencies, or commodities within the same trading day. It typically requires active monitoring of the markets and taking advantage of short-term price fluctuations to make quick profits. However, day trading can be risky and it's crucial to approach it with a well-thought-out strategy. Today, we have a special video for all beginners eager to dive into the world of day trading. We'll share 10 essential day trading tips to help you build a strong foundation for success. So, let's get started. Tip number 1. Knowledge is power, especially in day trading. Before you start day trading, you must educate yourself about the fundamentals of the stock market and trading strategies. This includes understanding how the market works, different types of financial instruments, and various trading techniques. Staying updated with the latest stock market news, economic events, and financial trends is essential. Various factors influence the stock market, including economic indicators, government policies, corporate earnings reports, and global affairs. You gain a competitive edge as a day trader by staying knowledgeable and up to date. This information lets you make informed decisions, identify potential trading opportunities, and adapt to changing market conditions. Remember, day trading requires constant learning and adapting to stay ahead in the dynamic world of finance. So, make it a habit to educate yourself continuously, stay informed about the latest news and events, and analyze relevant factors that impact the stocks you're trading. This knowledge will empower you to act and make well-informed trading decisions confidently. Tip number 2. Set aside funds for day trading. Set aside a specific amount to effectively manage your funds in day trading. Keep it separate from your regular savings or investments because day trading carries more risk. Once you have determined how much you can allocate to day trading, decide how much capital you will risk on each trade. It's important not to risk too much, as this could lead to significant losses and wipe out your trading account. Limiting your risk to 1% to 2% of your trading account per trade is recommended as a rule of thumb. Following this risk management principle ensures you won't lose all your trading capital even if you have a series of losing trades. This approach protects your account from significant losses and allows you to continue trading with the remaining funds. Tip number 3. Allocate sufficient time for day trading. To engage in day trading successfully, allocating an appropriate amount of time for the activity is vital. Day trading necessitates focused attention and real-time market monitoring. Key considerations include knowing the specific trading hours for your chosen market, actively tracking and analyzing market movements, conducting thorough market research, implementing effective trading strategies, and continuously learning to adapt to evolving market conditions. By dedicating sufficient time during trading hours, you enhance your prospects for success in day trading. Tip number 4. Start with a few stocks. As a beginner in stock trading, starting with a few stocks is recommended rather than trying to follow many of them. This approach allows you to concentrate your efforts and better understand the selected stocks and their patterns. By tracking and analyzing a small portfolio, you can observe how these stocks behave in different market conditions, identify trends, and make more informed trading decisions based on your observations. Additionally, it's worth considering the option of fractional shares when investing in stocks. Fractional shares allow you to buy a portion of a single share rather than purchasing a whole share. This makes investing in expensive stocks more affordable and accessible. For example, you are interested in a high-priced stock like Amazon, trading at several $1,000s per share. With fractional shares, you can invest a smaller amount, such as $100, and still own a fraction of an Amazon share. This allows you to diversify your investments across different stocks and sectors, even with a limited budget. By starting with a few stocks and considering fractional shares, beginners can gain valuable experience in stock trading while managing their investments more affordable. Tip number 5. Avoid penny stocks. For beginners, it's best to avoid penny stocks. Penny stocks are low-priced stocks traded for less than $5 per share. Although their low price may seem appealing, there are reasons to be cautious. One concern is their lack of liquidity, meaning they have low trading volumes and limited market interest. This makes buying or selling them at desirable prices difficult, resulting in higher transaction costs. Penny stocks are also highly volatile, prone to significant price fluctuations, influenced by even minor market news or events. This unpredictability increases the risk associated with investing in them. Instead, beginners should focus on established and liquid stocks of well-known companies. These stocks offer stability, follow more predictable patterns based on company fundamentals, and are easier to buy or sell. For example, investing in a reputable company like Coca-Cola or Microsoft provides a track record of consistent performance and greater liquidity. By avoiding penny stocks and opting for established stocks, beginners can reduce the risk of unpredictable price movements and make more informed investment decisions. Tip number 6. Time your trades strategically. As the market opens, activity surges and the stock experiences a sharp price increase. Instead of trading immediately, observing the market for the first 15 to 20 minutes is better to understand its direction and stability. This observation period helps you make more informed decisions by allowing the initial volatility to settle down. You can study price movements, identify trends, and assess market sentiment during this time. It's also advisable for beginners to avoid rush hours, periods of high trading activity, and increased volatility. Following these strategies increases your chances of making better trading decisions and achieving success in day trading. Tip number 7. Use stop-loss orders. Using stop-loss orders is an important way to manage risk in day trading. A stop-loss order is a preset instruction to sell a stock if it reaches a specific price. It helps protect your trading capital by establishing a threshold at which you can exit a trade to limit potential losses. Stop-loss orders are valuable because they prevent significant losses and keep you disciplined. In day trading, where prices can change rapidly and unexpectedly, having a predetermined exit point helps you avoid making impulsive decisions based on emotions. With a stop-loss order in place, if a trade moves against you and reaches the predetermined price, the stock is automatically sold, limiting your potential loss. For example, you buy a stock at $50 per share and set a stop-loss order at $47. If the stock starts to decline and reaches $47, your stop-loss order is triggered and the stock is sold automatically. This limits your loss to $3 per share, protecting you from further declines and preserving your capital. Stop-loss orders protect your trading capital and help you stay disciplined. By incorporating this risk management tool, you can effectively manage your risk exposure and safeguard against significant losses in day trading. Tip number 8. Be realistic about your profit expectations. When day trading, it's essential to have realistic profit expectations and understand that not all trades will be successful. Some will be winners and some will be losers. The key is to focus on overall profitability by ensuring that your winning trades outweigh your losing trades. To achieve this, set clear profit targets for each trade. Determine specific price levels at which you will take profits and exit the trade. Base these targets on your analysis, market conditions, and risk-reward considerations. By setting clear profit targets, you create a plan and avoid making emotional decisions based on short-term market fluctuations. Avoid deviating from your plan, as it can lead to impulsive decisions, chasing losses, and taking excessive risks. Stay disciplined and follow your predetermined strategies to make informed and rational trading choices. For example, you enter a day trade with a stock at $50 per share. After analysis, you set a profit target of $55. As the stock reaches $55, you sell it as planned, securing a $5 profit per share. Even if the stock rises afterward, sticking to your profit target ensures a win and contributes to your overall profitability. This helps manage risk, minimize emotional decision making, and strive for positive overall profitability in the long run. Tip number 9. Stay calm and emotion-free while trading. Maintaining a calm and emotion-free mindset while trading is crucial for successful day trading. Emotions such as greed and fear can significantly impact your decision-making and lead to impulsive actions that may not align with your trading strategy. To make effective trading choices, it's important to remain logical and objective, focusing on your predetermined strategy rather than being influenced by temporary market fluctuations. Greed can tempt you to chase profits beyond reasonable targets or take excessive risks. It may lead you to hold on to a winning trade for too long, hoping for even higher gains, only to see the market reverse and erode your profits. Similarly, fear can cause you to exit trades prematurely, missing out on potential profits and making hasty decisions based on short-term market movements. By staying calm and detached from emotions, you can make rational decisions based on your trading plan and analysis. This means following your predetermined entry and exit points, setting stop-loss orders, and adhering to risk management principles. It allows you to evaluate the market objectively and make decisions based on the overall strategy rather than being swayed by temporary market fluctuations or emotional impulses. Tip number 10. Follow your trading plan religiously. Your trading plan serves as a roadmap that outlines your strategies, rules, and techniques for entering and exiting trades, managing risks, and executing your trades. By following your trading plan religiously, you establish discipline and consistency, which are key factors in achieving long-term profitability. Risk management techniques are an essential part of your trading plan. Determine the maximum risk you will take on each trade and establish guidelines for position sizing, stop-loss orders, and profit targets. By incorporating risk management into your plan, you protect yourself from excessive losses and ensure that your trading activities are aligned with your risk tolerance. Maintaining discipline and consistency is crucial for implementing your trading plan effectively. Sticking to your rules and strategies is essential, even when faced with market fluctuations or tempting opportunities. By following your plan consistently, you avoid making hasty or impulsive decisions that can lead to losses or deviate from your overall strategy. And that wraps up our 10 day trading tips for beginners. Remember, day trading is a skill that requires continuous learning, practice, and self-discipline. Start small, manage your risks, and never stop expanding your knowledge. If you found these tips helpful, give this video a thumbs up and subscribe to our channel for more informative content. Feel free to share your thoughts and questions in the comments below. Best of luck on your day trading journey and see you in the next video. Happy trading!